Welcome to this explainer. Today, we're taking a really fascinating deep dive into the very heart of how businesses actually account for their physical investments. We're going to explore the somewhat complex rules of property, plant, and equipment, specifically through the lens of Accounting Standard 10, or AS10. Now, you might be wondering, why on earth should I care about a seemingly dry accounting rule? Well, because how a company accounts for its massive physical assets can completely transform its reported profit. It's absolutely crucial for understanding any business's true financial health. So rather than just reading through a boring list of rules, we're going to follow the chronological journey of a real business asset, literally from its birth all the way to its retirement.
Picture this. A major supermarket chain decides to spend millions remodeling one of its flagship stores. They're adding a shiny new restaurant, updating all the aisles, expanding the space. So what does this all mean? Is that massive pile of money just a temporary cost that completely drains this year's profits? Or is it a long-term investment that gets proudly recorded on the balance sheet? The stakes here are huge. If they expense it all right now, this year's profit is going to look absolutely terrible. But if they capitalize it as an asset, they look highly profitable. We're going to use this exact real-world supermarket scenario to frame how AS10 carefully separates everyday, run-of-the-mill expenses from valuable long-term assets.
To get to the bottom of this, here's our roadmap for today. We'll be hitting 1. Defining PPE and scope. 2. Measuring the initial cost. 3. Handling subsequent asset costs. 4. Cost versus revaluation models. 5. The rules of depreciation. And finally, 6. Retirement and derecognition. Basically, we're tracking this life cycle step by step.
All right, let's jump straight into Section 1, Defining PPE and Scope. Identifying the newborn asset. We have to figure out if an expenditure even qualifies to be borne onto the balance sheet in the first place. For an item to officially be classified as property, plant, and equipment, or PPE, it has to strictly pass a two-part test. First, it has to be a tangible item, something you can physically touch, so we're not talking about software or patents here. It must be a physical item held for producing goods, renting out, or for admin purposes. Second, it has to be expected to be used for more than a single 12-month period. Going back to our supermarket remodeling, because that new physical restaurant space is going to generate sales for years to come, it passes the test with flying colors and is officially born as an asset.
Now, interestingly enough, the scope of what counts as PPE under AS10 has some really fascinating exceptions. For example, the standard includes what are called bearer plants. Think of an apple orchard that just produces fruit year after year without being chopped down. However, it completely excludes other living biological assets like livestock, and it also excludes wasting assets like mineral extraction rights. Why? Well, because a tree basically acts like a biological factory that just pumps out fruit, whereas an animal grows and fundamentally changes over time, which requires an entirely different set of accounting logic.
Moving right along to Section 2, Measuring the initial cost, pricing the asset at birth. Now that we've identified our newborn asset, we have to precisely calculate its initial price tag.
So, what actually goes into that price tag? The golden rule here is that you can only capitalize costs directly attributable to bringing the asset to its intended location and working condition. Think of a massive factory machine. The purchase price, the site prep, delivery, installation, all of that is capitalized. But what if you throw a lavish inauguration party to celebrate it? Or you spend money training your staff to use it? Those are strictly operating expenses. They go straight to the profit and loss statement. Why expensed? Because employees can literally quit tomorrow. The training is tied to the human, not the machine. But hey, what if you don't buy the asset with cash? What if you barter for it? In this case, there's a strict hierarchy to measure its cost. If the exchange has genuine commercial substance, which just means it actually changes the company's future cash flows, you first try to measure it at the fair value of the asset you gave up. If that's not reliable, you use the fair value of the asset you received. And if the trade totally lacks commercial substance, you just record the new asset at the net book value of the old one you traded away. Net book value being whatever the old asset was currently recorded at on your books.
Let's fast forward a bit to Section 3, Handling Subsequent Asset Costs. This is the adulthood and maintenance phase of our asset.
The machine is running, the supermarket is open, but things need maintenance, right? We have to draw a hard line here between routine servicing and major overhauls. Routine maintenance, like daily labor, oil changes, small parts, that is immediately expensed. It's just the cost of doing business. But contrast that with a major replacement. Imagine an airline replacing the entire interior seating of a jet. That is a massive cost that restores the asset's life. Under AS10, that gets capitalized directly into the asset's carrying amount on the balance sheet, while the old, torn-out seats are completely derecognized, wiped clean off the books. Which brings us to Section 4, Cost versus Revaluation Models, tracking the asset's shifting value as it lives out its adulthood. Market conditions are going to shift over time. Real estate booms, machinery loses value. So AS10 gives companies two distinct choices. They can stick with the traditional cost model, which is just historical cost minus accumulated depreciation. It's stable, it's predictable. Or they can opt for the revaluation model, constantly updating the asset to its current fair value. But here's the catch. If you choose revaluation, you have to apply it to the entire class of assets. You can't just artificially inflate your worth by showing off your winning assets and hiding the losers. No cherry picking allowed. Now, when a company does revalue an asset, they have two mathematical techniques they can use. Let's make this real. Imagine a factory cost $100 but just doubled in market value to $200. With the proportionate technique, they scale everything, both the gross cost and the accumulated depreciation, proportionally based on that new data. Or they can use the elimination technique. This literally just zeroes out the accumulated depreciation entirely and resets the gross carrying amount directly to that new $200 fair value. Both methods get you to the exact same correct net book value. All right, moving to Section 5, the rules of depreciation, the inevitable aging process of our asset.
Regardless of your valuation model, assets get older and lose value. But it's vital to understand that useful life isn't just about a clock ticking on the wall. It is heavily dictated by several factors. Sure, physical wear and usage play a huge role. But a perfectly good piece of equipment might actually have a super short life due to rapid technological obsolescence. Think of a server farm. It could physically run for 20 years, but if next-gen chips make it commercially useless in 3, its useful life is 3 years. Full stop. Even strict legal limits, like a lease expiring, can dictate exactly how fast it depreciates.
Now there is a massive misconception about when depreciation actually stops. People think, hey, if I just unplug a machine and leave it sitting in a warehouse, I can pause the depreciation, right? Absolutely not. Idle assets still depreciate. The rules say depreciation only truly stops if the asset's estimated residual value, what you could realistically sell it for, actually exceeds its current carrying amount. Or it stops if the asset is officially retired from active use and explicitly held to be disposed of.
And that leads us to our final chapter, Section 6, Retirement and Derecognition, the end of the line. The inevitable day finally comes where the asset has exhausted its usefulness. How exactly does a business legally and financially declare an asset dead? Whether it's sold for scrap, totally abandoned, or tragically destroyed in a fire, the accounting mechanics have to handle the fallout.
First off, the carrying amount is completely wiped out from the books, derecognized. The company then calculates a gain or loss, just the net proceeds from disposal minus that carrying amount. But here is a super critical detail. What if the asset was destroyed by a fire and you're expecting an insurance payout? Under AS10, you still record the loss of the physical asset immediately. Any third-party compensation, like from the insurance company, is accounted for as an entirely separate receivable, and you only record it when you're absolutely guaranteed to get the money. You never, ever mix the two together.
So, to wrap up this explainer, we've seen how AS10 meticulously governs the birth, life, and death of physical assets. But I want you to consider this. As the accelerating pace of innovation in AI drives incredibly rapid commercial obsolescence, will the traditional concept of a multi-decade useful life for physical assets just become a thing of the past? Might we soon see a world where tangible business assets are retired and replaced faster than ever before, fundamentally changing how corporate balance sheets look? It's a pretty fascinating thought to keep in mind as you look at the financial statements of tomorrow. Keep learning, and I'll catch you in the next explainer.